Fed Chairman Ben Bernanke and former Chairman Paul Volcker will testify before the House Financial Services Committee 2 o'clock this afternoon. Catherine Mann is a former Federal Reserve economist and a professor of international economics and finance at the International Business School at Brandeis University. She joins us now from Waltham, Massachusetts, with a look at what to expect today. Welcome, Dr. Mann. Let me ask you first off, do you think the Fed, with this increased bank supervisory role, which it is seeking, will be more or less aggressive with its monetary policy?
Well, the relationship between oversight and regulatory authority and monetary policy has been a question that the Federal Reserve has faced for a long time. I don't think you can say they're going to be more aggressive with monetary policy because that's a little hard to define anyway. But I think what we do know is that the Federal Reserve's capacity to link oversight and regulatory authority and monetary policy is something that they've been thinking about for an extended period of time, just like low interest rates.
Speaking of low interest rates, we've seen the stock market rebound, but there are still troubled areas of the economy, notably high employment. So all that said, what are the implications from where we stand right now with Fed policy? We just had the meeting, of course, yesterday, low rates for the extended period.
I think that the continuation of the signal of low interest rates is a mistake for the Federal Reserve. And the reason why is because these extended period of low interest rates engenders transactions-oriented activities in the financial markets, equities, commodities, things like that. Whereas a 25 basis point increase or even probably a 25 basis point increase would do two things. First, it would get us out of the zone where the Fed funds rate is below the rate at which excess reserves receive on the Federal Reserve's balance sheet. So I think that's important to encourage bank lending. But even more importantly, 25 basis points increase would be a large percentage increase for transactions-related financial activities, but very small as a percentage increase for something like the prime rate, mortgage rates, and so forth. So I really think that the Federal Reserve has to be focusing not on interest rates that encourage transactions-related activities, mergers and acquisitions, trading, carry trade, and that sort of thing, but focus on those rates that are associated with real economic activity, because that's going to generate the kind of investment and job-related growth.
Now, as far as the end of the Fed's quantitative easing, Nobel laureate Joseph Stiglitz warning here the Federal Reserve's decision to let its mortgage debt purchase programs end this month risks driving up home loan rates, worsening the housing crisis. Do you agree?
Well, I disagree because the targeting of lending to the housing sector, although very important for the houses and the wealth of the consumer, that's not the main source of economic activity in the economy. What we need to see is a rebound in business investment, and targeting of consumer loans is not the strategy to do that.
Now, were you surprised with anything that came out of yesterday's FOMC meeting at all?
Well, I did think it was interesting that we had not a consensus on how to move forward with the language. I think we're seeing some breaks with the tradition of having a consensual view and having no explicit members go against the statement. And so I think what we're seeing is we're getting to be a little bit of a differences of views depending on what's going on in the different regions and the differences and concerns about the extent to which that these low interest rates are they really generating the kind of economic activity that is supportive of employment growth and infrastructure improvements, long-term rate of growth of the economy in the long term, or are these low interest rates really supportive of the kind of poker games that we saw as having the significant impact?
While we have you, I'd like to ask you about China because, as you know, there's been a lot of debate this week about whether China's currency value is the root cause of global imbalances. And as we talk about interest rates, there's also concern that U.S. rates will shoot up if China stops buying our assets. So where do you stand with this issue?
Well, of course, there are two related questions there. One, the extent to which the undervaluation of the renminbi is a cause of the global imbalances. And then the second question is whether or not if the Chinese altered their purchasing habits away from U.S. Treasury securities, would our interest rates rise? Well, on the latter point, if the Chinese stopped purchasing U.S. Treasury securities, that's not necessarily a bad thing. On the one hand, what it would do is it might have some impact on the U.S. Treasury rates, but at the same time, it would no doubt lead to a depreciation of the dollar, or be associated with the depreciation of the dollar, and the consequences for the U.S. economy of the depreciation of the dollar actually would be quite salutarious, because, of course, exporters would be able to be more competitive in international markets. And that would be supportive of the kind of real economic activity and real job-related growth that is something that we would like to see happening.
Our thanks to Catherine Mann, former Federal Reserve economist, professor of international economics, Brandeis University.